Most people assume the financial system is designed to help economies grow, stabilize markets, and improve living standards. But what if the system you rely on, your currency, your savings, your taxes, was quietly engineered to do something very different? What if it was built not to protect you, but to preserve something far larger, U.S. global dominance? Today, we're pulling apart a mystery that has shaped the last century of world power, a machine so efficient and so hidden that most citizens never realize how much they're feeding it. The mystery begins with a contradiction. The United States, the wealthiest nation in history, also happens to be the most indebted. Trillions of dollars in obligations, deficits every year, and borrowing that never stops. Yet instead of collapsing under its own financial weight, the U.S. turns this endless borrowing into leverage, into strength, into influence. The question is how and why the cost of this system is silently pushed onto ordinary citizens worldwide. To understand how this machine works, we must go back to the early 20th century, before America emerged as a global superpower. At that time, European empires dominated world trade, gold anchored currency values, and the U.S. was still figuring out how to transform its growing economy into global authority. The seeds of today's financial system were just being planted, and only a handful of bankers, politicians, and economists understood the implications of what they were building. The first major turning point came in 1913 with the creation of the Federal Reserve. Designed to stabilize banking, the Fed soon gained the power to create money, set interest rates, and act as lender of last resort. Few realized this institution would one day become the beating heart of the global financial machine. But even then, the United States had not yet discovered the full potential of debt as a weapon of influence. World War I changed everything. The U.S. lent billions to allies and supplied massive quantities of materials. By the end of the war, European nations owed the U.S. more than they could ever repay. America had unintentionally discovered a new form of leverage, financial dependency. Whenever a nation borrows, it becomes vulnerable. Whenever a nation lends, it gains influence, and influence is a form of power. Then came the Great Depression, a global collapse that tested whether governments could continue honoring their debts. Many countries defaulted, but the U.S. responded differently. It took the dollar off the gold standard domestically, revalued gold, and expanded federal spending. In other words, it rewrote the rules. A subtle lesson emerged. When a country controls the currency everyone else depends on, it can shape the global system to its advantage. The real transformation, however, came in 1944 with the Bretton Woods Conference. As World War II approached its end, the world's major powers met to rebuild the global financial order. The U.S. had the strongest economy, the largest gold reserves, and the only industrial base left intact. Unsurprisingly, the new rules placed the U.S. dollar at the center of international trade. The dollar became as good as gold, and the world agreed to hold it as their primary reserve currency. This arrangement gave America extraordinary power. Countries needed dollars to trade. To get dollars, they needed to export goods or borrow from U.S. institutions. This meant global demand for dollars created by foreign governments, banks, and corporations was effectively guaranteed. As long as the world wanted dollars, the U.S. could print, lend, and borrow with impunity. But this new system created a problem for other nations. To obtain more dollars, they had two options: run trade surpluses with the U.S. or take on more debt. Both came with hidden costs. Surpluses required suppressing wages and domestic consumption. Borrowing required accepting U.S. oversight through institutions like the IMF and World Bank. The U.S. had designed a system where everyone needed its currency, yet the U.S. itself faced no such constraint. The strain finally surfaced in the late 1960s, as the U.S. printed more dollars to fund military expansion and social programs. Foreign governments worried that dollars were no longer backed by adequate gold reserves. Nations like France demanded conversion of dollars into gold, a move that threatened to drain America's gold supply entirely. The system was reaching a breaking point. In 1971, President Nixon made a decisive and controversial move. He ended the convertibility of dollars to gold. Overnight, the global financial system became a fiat system, meaning currencies were backed by nothing but government decree. Instead of destabilizing the U.S., this shift gave it even more power. The dollar could now expand without limit, unrestrained by gold reserves. The world had no choice but to accept the new rules. But making the dollar the world's anchor without gold required something else. Global demand for dollars had to remain permanent. That's why the next step in the American financial machine involved energy. In the 1970s, the U.S. struck deals with Saudi Arabia and other OPEC nations to price oil exclusively in dollars. This petrodollar system forced every nation, whether friendly or hostile, to hold and use dollars to buy energy, the lifeblood of industrial economies. This was the moment when U.S. financial dominance became self-reinforcing. Countries needed dollars for oil, for trade, for reserves. To get dollars, they often borrowed from U.S. lenders or traded with U.S. companies. As dollars flowed globally, the U.S. ran growing deficits, but instead of weakening the country, those deficits exported dollars abroad, fueling more global demand. Meanwhile, American consumers enjoyed cheap imports, low inflation, and rising living standards. But the hidden cost was beginning to accumulate. Manufacturing jobs moved overseas, domestic industries hollowed out, and financial markets became increasingly dependent on constant debt expansion. A quiet shift occurred. The U.S. economy became more financialized, less productive, and more reliant on the world's demand for debt. Throughout the 1980s and 1990s, the machine grew more sophisticated. Deregulation, globalization, and capital mobility allowed U.S. financial institutions to expand worldwide. The dollar became the backbone of international loans, derivatives, and corporate financing. Countries that tried to escape the system, like Argentina or Southeast Asian economies, found themselves punished by financial crises that brought them back under global lending institutions. Each crisis reinforced the same pattern. The U.S. dollar rises, capital flees to American assets, and struggling countries must borrow more dollars to stabilize their economies. The machine extracts value silently. Citizens in those countries pay through austerity, inflation, or unemployment, while U.S. financial institutions profit from interest payments, asset purchases, and economic leverage. Then came the great financial crisis of 2008, a moment that should have shattered confidence in the U.S. system. But this benefit comes with a hidden cost for U.S. citizens too. As the government borrows endlessly to support global liquidity, domestic inflation gradually erodes purchasing power. Savings lose value, wages stagnate, the wealth gap widens as financial assets owned mostly by the wealthy inflate far faster than incomes. The average American is paying silently for a system that secures geopolitical influence. Meanwhile, other nations face even harsher realities. Countries with dollar-denominated debt struggle whenever the Fed raises interest rates. Their currencies weaken, debt payments rise, and governments either impose austerity or seek emergency loans. This cycle has occurred dozens of times across Latin America, Africa, and Southeast Asia, each time weakening local stability while strengthening dollar dominance. Even developed nations are not immune. Europe depends on the dollar for energy and trade financing. Japan relies on it to stabilize markets. China, America's primary geopolitical rival, holds trillions in U.S. assets because it cannot unload them without triggering global shockwaves that would harm its own economy. Every path leads back to the dollar system, and so, the machine continues. The U.S. runs deficits, prints dollars, and borrows trillions. Foreign governments buy U.S. debt to stabilize their currencies. Financial institutions profit from global capital flows. Ordinary citizens both in the U.S. and abroad pay through inflation, reduced public services, slower wage growth, and economic vulnerability. The question now is whether this machine is sustainable. In recent years, U.S. debt has exceeded levels previously thought unmanageable. Interest payments have become one of the largest components of the federal budget. Yet the system continues functioning because the world still demands dollars. But history shows that no financial order lasts forever. Eventually, imbalances reach breaking points. Emerging blocs like BRICS are attempting to reduce dependence on the dollar. New trade agreements bypass the U.S. currency. Central banks worldwide are quietly increasing gold reserves. Digital currencies and alternative payment systems are emerging. But even as alternatives rise, a paradox remains. Every time global uncertainty increases, demand for the dollar surges. It channels global wealth into U.S. assets, exports financial risk, and shields American geopolitical influence. And because the system works silently through interest rates, currency flows, and debt cycles, most people don't see what's happening until the consequences reach their wallets. 3 lessons emerge. First, global finance is not neutral, it is structured to benefit those who set the rules. Second, national debt is not simply an economic issue but a strategic tool, capable of shaping global power. Third, citizens everywhere pay for decisions made by institutions that operate far beyond democratic control. But the biggest question remains, how long can a system built on constant borrowing, rising inequality, and global dependence continue? Will it evolve peacefully, fracture slowly, or collapse suddenly under its own weight? No one knows the timeline, but history suggests that financial orders change not when people expect, but when pressures quietly build beyond the point of stability. If there is a warning, it is this: the more complex and hidden a system becomes, the more vulnerable it is to shock. Whether the next disruption comes from geopolitical conflict, technological transformation, or a global debt crisis, the entire world will feel the impact. And the silent machine that has shaped the last century may face its greatest test yet. If you found this breakdown eye-opening, consider subscribing for more deep explorations of the systems shaping global power. Like the video, share it with someone who wants to understand the world beyond headlines, and let's continue unraveling the forces that quietly govern our financial reality. Thank you for watching.